Welcome back to EDS, and in this video I'm going to show you how you can grow a small account by selling options contracts or writing options contracts, collecting a premium upfront and generating consistent returns. So the first thing you want to do is navigate to any equities underlying. We've got GLD open up at the moment. We've just taken a winning position off on GLD, which is quite nice. It is Boxing Day today, so it's a nice little late Christmas present for us. And you want to navigate over to where you can see a list of expiration dates for that particular underlying. It doesn't matter which underlying you pick, all expiration dates are the same for equities. And the purpose of this is we want to pick an expiration date that we can use to mock up positions moving forwards. And the one that we want to choose needs to be between 30 and 60 days out in time. The only one that actually currently fits that criteria is February 21st. It's also important to note that you want to stick to monthly expiration dates, not weekly or quarterly. As you can see here, this is a quarterly, March 31st, January 21st, January 31st, February 7th. These are weeklies. So ones without anything next to it is a monthly. The monthly is just the default. So 57 days, and we can take that information, come over to our watch list, and we can simply filter out any and all underlyings that have an earnings event over the next 57 days or within the next 57-day period. The reason for this is because you want to remember we're writing options contracts and selling it onto the market, right? So whenever we're doing that, we're basically short the position. And when you're short, it means you're trying to sell high and buy back lower later on. Now, high volatility means high options prices. So we want to sell when volatility is high and then buy back when volatility contracts. Volatilities also mean reverting. So we want to avoid earnings announcements or earnings events. You can make earnings plays, however, the way you trade that is slightly different to what we're showing you in this video. So for your main bread and butter of your portfolio, you want to avoid earnings, and you also want to filter out anything that has a low liquidity rating level. This is because we only want to trade tight markets, tight spreads, liquid markets. The tighter the spread, the less you're going to pay to get in and get out of a position. And the only way you can get tight spreads is by having liquid markets. So you'll be left with something that looks like this. I personally like to order my watch list from high to low implied volatility rank. And then at this point, we just go down the list and see what would fit well inside of our portfolio. Just make sure that everything is nice and diverse. Use common sense and you'll be fine. And you want to pick something that is on the small side if you have a smaller portfolio. So for example, if we take a look at EWZ, which is the Brazil ETF, you'll notice it's trading at just under $23 a share. It's got an IV rank of 83.2, an absolute IV level of 33.4. Now this is quite high for an ETF. Remember, ETFs don't have company risk, so your P&L curve will typically be smoother with ETFs. However, you'll generally collect less premium upfront, and there should be no surprise with that. With more risk comes more reward. Less risk comes less reward. So this is the chart for EWZ. We don't trade based off of the chart. We just trade based off of statistics, deltas, volatility, that kind of stuff. But just a visual representation so you can see where EWZ is with respect to what it has been doing in the past year. And we want to just go straight over to where we can see a list of expiration dates, and we're just going to navigate over to February 21st because that's the expiration date that we already locked in at the beginning of this video. So at this point, what you want to do is simply sell one call and one put. Now this orange horizontal bar shows you where price currently is with respect to the strikes. On your left side you have calls, on the right side you have puts. This vertical orange bar shows you what the expected move is of EWZ over the next 57 days. Now, if you remember at the beginning of this video, we said we want to trade smaller underlyings for smaller accounts. EWZ is a small underlying, so that's fine. We want to trade when there's high implied volatility. EWZ has an IV rank of 83, which is fine. And we also want high probabilities of success. Now, the reason why you want high probabilities of success is because it's much easier to win 9 trades and then manage one loser than to win one trade and manage 9 losers. So we want as many winning trades as possible, and then we can worry about how to manage the risk and make adjustments on the losers, and the less losers you have, the easier it is. So, and also not to mention, the more consistent your returns will be. So what are we going to do? Where are we going to sell these contracts? Well, we know what the expected move is, so we want to sell outside of the expected move. Anytime you are writing a contract, you don't want price to go beyond that contract. Basically, you want price to stay away from that contract. So we want to sell contracts that land outside of this expected move. But how far out do we go? Because the further out we go, the less premium that we will collect. Now we've got these blue dotted lines here, which are our standard deviation levels. And as a general rule of thumb, we want to be selling contracts around the 1 standard deviation mark, outside of the expected move. And just as a further point of confirmation, I personally like to sell contracts that are between 15 and 20 deltas. So we've got the delta column on the left and on the right for calls and puts. And what you'll notice is all 3 of these things will line up, and you'll typically end up at around about the same spot for every position, every underlying. So what we want to do here, we've got an 18 delta on the call side, and then on the put side we have a 14 delta. Now as you can see here, these contracts line up perfectly. We are outside of the expected move, we are in and around the 1 standard deviation mark, and we're between 15 and 20 deltas. 1 or 2 deltas here or there doesn't really matter too much, just as long as you're in and around 15 and 20 deltas. Now what you'll notice is we can see this green bar here, which is our break-even bar. So as long as price is anywhere within this green bar at the point of expiration, we will make money. And as you can see, the green bar overshadows the orange bar, which is going to lead to a high probability of success. Now we've got a pop here in the bottom left corner of 75%, which means that there is a pop is probability of profit, which means that there is a 75% chance of making at least 1 penny on this position at expiration. Now if we don't want to wait all the way to expiration and we just want to get out at say 50% of max profit, we've got an 88% chance of being able to hit that 50% target at some point over the next 57 days. So we're looking at probabilities of success within 75 and 88%, which are very, very high probabilities of success. Now, as soon as this order gets filled, we will collect the premium up front that gets deposited into our cash balance. And as we can see here, this is the premium that we would collect, 50 cents. Now, you have to multiply this by 100 because each contract controls 100 shares of the underlying. So this would be 50 cents multiplied out by 100, which would give us a max profit of $50. So we would collect $50 up front as soon as this order gets filled. Now, our broker is going to need $228, just over $228 in buying power to open this position. Now, this is a very nice return on capital, especially with it being a naked position. We enjoy very high probabilities of success, very small buying power requirements, therefore it's suitable for small accounts, and we have a nice and high return on capital, which is going to really help you to grow your account. Now, how do we know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template. The link will be in the description. And the way it works is you enter in the size of your portfolio at the top, and then you enter in whatever the current VIX level is below it, and then everything will then be automatically calculated for you. So at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this template, you will be absolutely fine over the long term. You won't have any problems. And if you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up, and inside you will have access to our portfolios that will allow you to see the exact positions that we're placing, live, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you absolutely everything that you need to know from start to finish. It is also a private community, so if at any point you get stuck, you can speak with myself directly or with other like-minded individuals, and there's also a 100% money back guarantee. So after you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part, and right now it's £1 a month to join. The price will be increasing. It's so cheap right now because we've just launched, so you are definitely rewarded for getting in early. And the aim of EDS Premium is within 6 to 12 months to get you to a point where you can write options contracts and generate consistent returns year on year, completely by yourself without any external help or influence. You're always welcome to stay and be a part of the community. However, within 6 to 12 months, you should be able to do this for the rest of your life. It's a skill that no one can take away from you. So with that being said, I will see you guys on the inside.